welcome back to Prime Wealth. We're so glad you're here with us today.
Yeah, it's great to see you all. We've got a really important topic to dive into today.
Absolutely. We're talking about portfolio diversification. You know, the classic advice of not putting all your eggs in one basket.
Right. Because if one basket drops, well, you could lose everything, right?
Exactly. And it can feel a bit overwhelming sometimes, especially if you're not sure where to start.
Totally. But that's why we're here. We want to help you understand how to spread out your investments so you can feel more secure about your financial future.
Yeah. So we're going to cover some key strategies for diversifying your portfolio, like what types of assets to consider, and how to balance risk and reward.
And we'll also touch on some common mistakes people make when they're just starting out with investing.
That's so important. It's easy to get caught up in the excitement and, forget some of the basics.
Exactly. But don't worry, we'll break it all down in a way that makes sense.
So whether you're a seasoned investor or just getting started, we've got something for you today.
All right, let's jump in and start exploring the world of portfolio diversification.
Hey everyone, welcome back to Prime Wealth. Today, we're diving into a topic that's super important, especially if you're over 40, and that's portfolio diversification.
Yeah, absolutely, Jordan. You know, it's easy to overlook, but diversifying your portfolio can really make a huge difference in your financial well-being as you age.
Right? And I think for a lot of people, once they hit their 40s, they start thinking more seriously about retirement, or at least they should be.
Exactly. And one big concern is that you might have your eggs in one basket without even realizing it.
Yeah, like, let's say you've been investing heavily in your company's stock because it's done well over the years.
Oh, definitely. That's a common scenario. I mean, you might feel really secure in that choice, but if the company hits a rough patch, which can happen, you could be in for a rude awakening.
Right. I was reading a statistic recently that said people over 40 are actually more likely to have a significant portion of their investments tied up in employer stock.
Wow, that's really eye-opening. And, that's concerning, because if you're too concentrated, you risk losing not just your job, but your savings, too.
Yeah, and think about it, Alex. If you're in your 40s or 50s, you might be closer to retirement than you think. The last thing you want is to lose a chunk of your savings right when you're planning to, kick back and enjoy life.
Absolutely. It's all about balance. And recent trends show that markets can be really volatile. Just look at what happened during the pandemic.
Totally. I mean, the market took a nosedive, but then it bounced back. But not everyone was prepared for that kind of roller coaster ride, right?
Right. If you were heavily invested in just one area, you could have been really affected.
And it's not just about the stock market either. I mean, think about real estate. Many folks put a lot of their wealth into their homes.
Yes. And while that can be a good investment, it's risky if you're overly dependent on that one asset.
Exactly. So let's say you've got all your wealth tied up in your home, and then the housing market takes a hit. Suddenly, you could be in a tough spot.
That's why diversification is so crucial. It helps mitigate those risks. And it's not just about stocks and real estate.
Right. I've heard people say, oh, I'm diversified because I own a bunch of different stocks. But if those stocks are all in tech or healthcare,
then in reality, they're not as diversified as they think.
Exactly. It's like if you love Italian food and you only ever eat at Italian restaurants, you might miss out on some really great other cuisines.
Ha! I love that analogy. So what's the takeaway here?
Well, I think the takeaway is that as we get older, it's crucial to take a step back and really assess your portfolio.
Yes, and to ask yourself, am I too concentrated in one area?
And while we're talking about numbers, we should also mention that emotional impact, right?
Definitely. You know, if you're heavily invested in a single stock or sector and it tanks, it can lead to a lot of stress and anxiety.
Yes. And that kind of stress can seep into other areas of your life, like your health or your relationships.
Right. It's just not worth it.
I think another issue people face is that they might feel overwhelmed by all the options out there.
For sure. I mean, there are so many investment vehicles and strategies today. It can feel like you're drowning in information.
Exactly. And that can lead to analysis paralysis.
Yes. So it's important to simplify it. You can start by thinking about your overall financial picture.
Right, like, what are your goals? Are you planning for retirement, college for your kids, or maybe even a big vacation?
And then consider how different asset classes can work together to help meet those goals.
Yeah, like maybe you want a mix of stocks, bonds, and maybe even some alternative investments.
Exactly. And don't forget about the importance of time horizon.
Yes, if you're closer to retirement, you might want to shift toward more conservative investments.
And if you're further away, you might take on more risk for potential growth.
I love that we're emphasizing this because it really does come down to your personal situation.
Absolutely. Everyone's journey is different, and that's what makes it so important to create a customized strategy.
So as we wrap up this section, let's encourage our listeners to take a good look at their portfolios and think about how diversified they really are.
Yes. And remember, it's never too late to make changes that can benefit your future.
Well said, Alex. All right, folks, stay tuned because after the break, we'll share some actionable strategies to help you diversify your portfolio effectively. Welcome back to Prime Wealth, everyone. Today we're diving into a really important topic, portfolio diversification.
Hey there, Jordan. Yeah, this is such a crucial aspect of investing, especially for folks over 40. You know, it's all about not putting all your eggs in one basket.
Exactly. So let's break it down. What does diversification really mean in practical terms?
Well, at its core, diversification means spreading your investments across different asset classes, like stocks, bonds, real estate, and even cash. The idea is to reduce risk. If one investment does poorly, others might do well.
Right, so it's kind of like a safety net?
Exactly. Think of it like a three-legged stool. If one leg is weak or breaks, the stool can still stand if the other two are strong.
That's a great analogy. So how can someone start diversifying their portfolio?
First off, I'd say take a good look at what you currently own. You know, assess your investments. Are you heavily weighted in one area, like tech stocks?
Yeah, I can see how that could be risky if tech takes a hit.
Right, and then your whole portfolio could suffer. So, a good rule of thumb is the 60/40ths rule.
Oh, what's that?
It's a simple strategy where you allocate 60% of your portfolio to stocks and 40% to bonds. This is a good balance for many people, especially as they approach retirement.
Okay, but should everyone stick to that 60/40th split?
Not necessarily. It really depends on your risk tolerance, age, and financial goals. A younger investor might lean more towards 80/20ths or even 90/10ths, while someone closer to retirement might prefer a more conservative allocation.
Got it. So how do we decide what types of stocks and bonds to invest in?
Good question. It's important to consider different sectors of the economy. For instance, you might want to invest in healthcare, technology, consumer goods, and energy. That way, you're not just reliant on one sector.
So maybe looking at index funds could help with that.
Absolutely. Index funds track a broad market index, like the S&P 500, and give you exposure to a wide range of companies.
So it's like buying a small piece of a lot of different companies at once?
Exactly. And it's typically less risky than picking individual stocks. Plus, it often comes with lower fees.
Okay, I'm starting to see the bigger picture here. What about bonds? How do those fit in?
Bonds are generally considered safer than stocks. They can provide stable income through interest payments. When you invest in bonds, you're essentially lending money to companies or governments.
So it's like a loan that you get paid back for?
Right. And when you diversify with bonds, you can help offset the volatility of stocks, especially in market downturns.
That makes sense. So what about real estate?
Great point. Real estate can be another way to diversify. It's not just about stocks and bonds. Investing in property or real estate investment trusts, REITs, can add another layer of security and potential income.
Wow, I didn't realize there were so many options.
Yeah, and you can even consider commodities, like gold or silver, which can act as a hedge against inflation.
So it sounds like the key is to have a mix of different asset classes.
Exactly. And don't forget to periodically rebalance your portfolio.
What does that mean?
Well, over time, some investments may grow faster than others. Rebalancing means adjusting your portfolio back to your target allocation. So if your stocks have significantly outperformed, you might need to sell some to maintain that 60/40th balance.
Oh, I see. It's like trimming the hedge to keep it neat.
Exactly. It's all about maintaining your intended risk level.
And how often should someone consider rebalancing?
A common approach is to do it annually. But if you have a big market shift or a life change, like retirement or a new job, you might want to reassess sooner.
Got it. So let's talk tools. Are there any resources or apps you recommend for this?
Definitely. There are several investment platforms that offer automated rebalancing. Look for ones that provide diversified portfolios based on your risk level. Some popular ones are Betterment or Wealthfront.
And they handle all the nitty-gritty for you, right?
Exactly. They simplify the process, which is great, especially if you're busy with other life commitments.
So we've covered a lot of ground here. To sum it up, diversification is crucial for managing risk, and there are many ways to achieve it.
Right, and remember to continually assess and adjust your strategy as your life changes.
Speaking of changes, let's transition into some common pitfalls people might face when trying to diversify their portfolios.
Great idea. There are definitely some traps to avoid.
Yeah, let's dive into those next. So Alex, today we're diving into a really important topic. Portfolio diversification.
Yeah, absolutely, Jordan. It's one of those foundational concepts in investing, but so many people still make some pretty common mistakes.
Right? I mean, we hear about it all the time, but it can be easy to overlook the basics. What do you think is the most common pitfall?
Well, a big one is definitely not diversifying enough. Like putting too much money into just one stock or one sector.
Yeah, I've seen that happen. It's like people get really excited about a single company, and then they just go all in.
Exactly. And then if that stock takes a hit, it can be devastating. I remember one client who put a large chunk of his savings into a tech startup. It was doing great for a while.
But then?
Well, it launched a product that flopped, and the stock plummeted. He lost a significant amount of his investment because he didn't have other assets to cushion the blow.
Ouch. That must have been tough for him. So, what would you say are some signs people should look out for?
Good question. One sign is if you find yourself overly anxious about a particular investment. If you're constantly checking the stock price, that's a red flag.
Totally. I think that anxiety can really cloud judgment too.
Right, and it can lead to bad decisions like selling at a loss just to relieve that stress.
So what about those folks who think they're diversified because they own several stocks?
Yes. That's another common misconception. They might own 10 different tech stocks thinking they're diversified. But really, they're all tied to the same industry.
Exactly. It's like wearing a bunch of different shirts, but they're all the same color.
Chuckles. Exactly. You need to think broader, like across different sectors, geographies, and asset classes.
What about bonds or real estate?
Yes, those are great examples. Incorporating fixed income or real estate can provide stability. I had a client who thought, I'm safe with my tech stocks, but he never considered bonds, which could have balanced his portfolio.
And how did that turn out for him?
Well, when the market dipped, his portfolio took a hit. He realized too late that he needed that balance.
So it's about creating a buffer, right?
Exactly. And another pitfall is not regularly rebalancing your portfolio.
Oh, that's a big one. So can you explain what rebalancing means?
Sure. It's basically adjusting your portfolio back to your target allocation. Over time, one part of your portfolio may grow faster than others, and you want to ensure it doesn't become too risky.
I see. So if someone had a mix of 60% stocks and 40% bonds, but the stocks performed really well, they might end up with like 80% stocks and 20% bonds, right?
Exactly. And that can expose them to more risk than they intended.
So how often should someone consider rebalancing?
Generally, I'd say at least once a year. But, if the market is really volatile, you might want to check in more often.
That makes sense. Now let's talk about how to recognize those danger signs.
Sure. One classic sign is if you're not meeting your investment goals. If you've set specific targets and you're consistently missing them, that's a wake-up call.
Or if you find yourself feeling really stressed about finances, like you mentioned earlier.
Right, stress can be a huge indicator. And Also, if you're relying on one or two investments to carry your entire portfolio.
Yeah, that's risky. I mean, what if those investments falter?
Exactly. Diversification is like insurance against that risk.
So if someone recognizes these signs, what can they do?
Well, first, I'd suggest taking a step back and evaluating their current portfolio. Look at the allocation and maybe consult with a financial advisor.
That's a good point. Sometimes a fresh set of eyes can really help.
Absolutely. And then start to explore different asset classes. Maybe look into mutual funds or ETFs that offer built-in diversification.
That's a great idea. It can make it easier for someone to get that balance without having to manage a ton of individual stocks.
Exactly. And remember, diversification doesn't mean you need to own every single asset out there. It's about spreading risk in a smart way.
So it's more about a well-rounded approach.
Yes, well-rounded is perfect. And don't forget to keep educating yourself. The more you know, the better decisions you can make.
Definitely. So to wrap it up, if listeners find themselves in any of these pitfalls, the key is to recognize it, reassess, and seek help if needed.
Exactly, Jordan. It's all about taking control and making informed choices.
Thanks for sharing these insights today, Alex. It's been really enlightening.
My pleasure, Jordan. Always happy to help.
And to our listeners, remember, you don't have to navigate this alone. Stay curious, keep learning, and take those next steps toward a more secure financial future.
So, Jordan, now that we've talked about why diversification is important, let's dive into some practical steps. Things people can start doing today.
Yeah, absolutely. I think a lot of folks might feel overwhelmed by the idea of diversifying their portfolios, but it doesn't have to be that way, right?
Exactly. A good first step is to assess what you've already got. Take a good look at your current investments. You can use an app like Personal Capital or Mint to get a clear picture of your assets.
Oh, I love Personal Capital. It helps you see everything in one place, right?
Yes. And once you have that overview, you can really start to see where you might be too heavily invested in one area, like, say, tech stocks or real estate.
Right. And that's a great segue into the next step, which is to set some diversification goals. What do you think about, like, a 60/40 stock-to-bond ratio, Alex?
That's a solid starting point for many people. But it really depends on your risk tolerance. Younger folks might lean more towards stocks, while those closer to retirement might want to shift more into bonds.
So it's about finding what works for you personally, and not just copying someone else's strategy, right?
Exactly. And once you have your goal, you can start small. Maybe set aside a small percentage of your monthly income just to invest in a different asset class.
I love that. Even if it's just 5% or 10%, it adds up over time.
For sure. And if you're unsure about where to put that money, consider index funds or ETFs. They're a great way to get broad market exposure without needing to pick individual stocks.
Yeah, and they usually have lower fees, which is a win-win.
Right. And speaking of fees, it's worth checking the expense ratios of the funds you're considering. High fees can eat into your returns over time. So, it's good to be mindful of that.
Definitely. And if someone wants to be a bit more hands-on, they could look into robo-advisors like Betterment or Wealthfront. They help you with diversification automatically, don't they?
Yes, they do. They create a diversified portfolio for you based on your risk tolerance and goals. It's a great option for folks who might feel intimidated by investing.
And those platforms usually have low minimums too, which is perfect for someone just starting out.
Right. And let's not forget about building habits. Consistency is key. Setting up automatic contributions can help make investing feel more manageable.
Oh, for sure. Automatically transferring a set amount each month to your investment account. It's like paying yourself first, right?
Exactly. And over time, you'll likely feel more comfortable with the process. And you might even start to enjoy watching your investments grow.
So true. And for those who want to learn more, I'd recommend books like The Intelligent Investor by Benjamin Graham. It's a classic.
That's a fantastic choice. Another one I like is A Random Walk Down Wall Street by Burton Malkiel. It's very approachable and full of great insights.
Those are both excellent. Plus, there are so many podcasts and online courses available now, too.
Yes, the resources are practically endless. And, the more you learn, the more confident you become in making decisions.
Absolutely. Oh, and let's talk about tracking your progress. It can be super motivating to see how your portfolio grows over time.
For sure. You can use those same apps we mentioned earlier, or even a simple spreadsheet if you prefer. Just keep an eye on your asset allocation and adjust as necessary.
Right, and don't forget to rebalance periodically. If one investment starts to take off, you might find yourself out of alignment with your goals.
Exactly, Jordan. It's all about keeping that balance and being willing to adapt as your life situation changes.
So, to recap, start by assessing your current investments, set diversification goals, and begin small. Use apps or robo-advisors and build consistent habits.
Yes! And remember, it's a journey. You don't have to do it all at once. Just take those small, actionable steps.
I think that's such a comforting thought, and it makes it feel much more achievable.
Absolutely. And before we wrap up, I just want to encourage everyone listening. Take action today, even if it's just a baby step.
Yes, you've got this.
All right, let's move on to the outro.
Wow, Alex, that was such a great discussion on portfolio diversification. I feel like we really unpacked some important concepts, didn't we?
Absolutely, Jordan. It's crucial for everyone, especially those over 40, to understand how to spread their investments, to reduce risk.
Right, so just to recap, the first key takeaway is don't put all your eggs in one basket, like we mentioned. It's about having a mix of assets, right?
Exactly. And the second takeaway is to consider your risk tolerance. Everyone's is different, and well, it's important to align your portfolio with your comfort level.
Yeah, and I think the third point was about regularly reviewing your portfolio. Markets change, life changes, so staying on top of your investments is super important.
For sure. And let's not forget the value of education, like understanding the different asset classes. The more you know, the better decisions you can make.
Definitely. Knowledge is power, right?
And it really can lead to peace of mind when it comes to your finances, which is what we all want.
So if you found this episode helpful, please like and subscribe to our channel and share it with someone who's over 40 and might need this advice.
And we'd love to hear your thoughts, so drop a comment below. What strategies do you use for diversification?
And don't forget, next time we'll dive into retirement accounts, like 401 kiloseconds, IRAs, and HSAs. It's going to be super informative.
Yeah, so make sure to tune in for that.
Thanks for joining us today, everyone.
Take care. And remember, you've got this.
Bye for now.